My name is Casey Fulp. I'm the owner and principal of Carriage Planning. I want to welcome you today to a second quarter of 2023 market update video. Today I want to offer some insights in terms of what I'm watching in the markets as far as the investment marketplace is concerned. I'm going to feather in though some planning thoughts with regards to personal financial planning. Ultimately here at Carriage Planning we are a financial planning firm first. That being said, recognizing how markets are acting and how our portfolios are positioned, of course, adds additional value to our overall financial plans. So we can't ignore the market completely. But that being said, as I mentioned, I want to feather in a couple of planning considerations today while we talk about the markets. But by and large, for the most part, I just simply want to give some insight in terms of what I'm seeing and what that might suggest we should anticipate as we look forward. Because right now there is a lot of question up in the air. Are we out of the weeds yet? Are we in the clear? Have we finished this rather painful event that is not just 2022, but truthfully the post-2019 affair that is all-encompassing of things from COVID all the way through to COVID policy and global shutdowns, supply chain issues. There's just been so much uncertainty. And then of course, most recently we've had this debt ceiling conversation and whether the debt limit increase is going to be detrimental long-term. And there's a lot of implications there as well. So without further ado, let's kind of address this idea of are we out of the weeds? Are we in the clear as far as the market's concerned? Are we in a position where we should feel comfortable taking on additional risk, for lack of a better word? Are we in a type of marketplace where additional risk might be warranted? I think to start that conversation, a good place to begin, and bear with me here as I pull up some information. Here we are at the start of June of 2023. That being typically, summer months have this reputation of being slow. Yes, the kind of invention of internet everywhere in your pocket at all times has of course sped up or increased the amount of activity that occurs in the summer months. While we like to believe we go on vacation, the hard truth is so many of us don't. Even when we're on vacation, our phones are with us, our iPads are with us, our laptops are with us. There's Wi-Fi somewhere, unless of course you're fortunate enough to go to the remotest depths of the earth. But that being said, looking here, dating back to 1958, and then of course, factoring in sort of what we might anticipate going forward through 2023. This data was aggregated at the end of April of 2023, so April is updated for this year. But this is giving us a good idea as to the not only average performance, and average by way of median performance of markets, specifically the S&P 500 as a proxy for our broader domestic equity markets. But it's also, I think it's an insightful piece because we talk a lot about market seasonality. We do recognize that there is some influence that the seasons have in terms of markets, whether it be the performance, whether it be the volume or the velocity of markets or a lot of other factors involved. As we approach this June month, you're going to notice we've got this not only median increase in average month-to-month performance, but notice how much wider these bands are, and then how much they compress here in the summer, and then they widen out drastically as we approach the second half of the year. Now, the real takeaway from that, and what I want to draw your attention to is, it's not so much that summer months are always bad. Of course, on average, yes, the summer months are less productive than are the months, post-August. We kind of, if we were to break the year down 6 months and 6 months, some would say sell in May and go away. There's a lot of stock market adages. But if you were to be a purist investor and say, I'm going to only buy one thing, and that's the S&P 500, and I'm only going to buy it in September, and I'm going to sell it, I'm going to own it for September, October, November, December, January, February, and then sometime between March and May, I'm going to sell it, so I own it for 6 months and I'm out for 6 months. Yes, the summer months underperform, or what would be deemed the summer months underperform, and I think the again, the takeaway here is that's on average. There are always going to be situations where the summer months maybe do better, maybe do worse, but on average, the summer months don't do as well. What I want to draw attention to, though, is there is going to be typically compression in terms of the range of markets, meaning the upside potential is capped, but then again, you can make the same argument that so is the downside potential. So we don't want to necessarily lament the summer months, and we don't always want to say sell in May and go away, or don't participate in markets during those vacation months or whatever it is. But as we've seen this seeming strength moving us up through the first part of 2023. We saw a nice burst there in January, February. Of course, with the bank concerns in March, we saw some significant selling, whereas some parts of the market weren't as affected as others. But broadly, if we were to look at all domestic stocks, there was some significant selling in March, April. And then we've had this renewed robust move up, at least in the major headline indices, specifically the S&P 500, the NASDAQ 100. So a lot of people are saying, okay, is this the sign that we're out of it, right? We're on our way out. Had this happened in June, let's say here, July, August, September, and then here we are in October, I would say, you know what, maybe so. But if we're looking at it through the lens of market seasonality, June might not be the best month to come up next as far as what's next in store, because that month typically doesn't have any robust activity one way or the other. So it very well could be a sign that this rally was a blow-off rally, that it might fizzle out. But in order to really answer that question, we can't look so broadly. We need to get a little bit kind of down and dirty and take a look at sort of some characteristics of the market. And then I'll help kind of draw a conclusion as to what we see and what we're expecting. Next up, here we are with just the S&P 500 index. So this chart is just charting from roughly the COVID lows forward the S&P 500 index's performance. Now on this chart, you're going to see a couple of lines. The hard red line at the very bottom at 3580 roughly represents that ultimate low that we experienced in the markets, and it's selling through 2022. So that does reflect or it represents an important level in our eyes. But just above that is actually a more significant level, and that is our red light 2 indicator. Now, why red light 2? Well, we've already had a red light. We are still in a red light territory as far as our broadest domestic equity indicator is concerned. Our, not to say master indicator, but our indicator that says whether we are in a marketplace or an environment where risk is most certainly justified. We're not in that place. We had a red light indicator come in back in June of 2022, and since then we have not yet reached the point where we've triggered our green light indication that yes, we need to be accepting additional risk in our portfolios. So that's kind of a little foreshadowing. That's what these two lines up here are, these hard green lines at roughly 45.60 and then 46.33. Those are roughly where our green light indicator and then our green light confirmation will be. So if we can reach that first line, that's ready the troops, it's time for action type of thing in terms of bringing additional risk into our portfolios. But we get that confirmation at 46.33, and these are not fixed. These will adjust. These will vary as time goes on. But as of right now, a quick timestamp, that's kind of what we're looking at. So the takeaway there is we have about 6 to 8% of upside performance needed in the S&P 500 before we're in the territory where we feel that we can bring in that additional risk metric or those kind of more aggressive positions. And I say that very loosely. When I say more aggressive, based on you as an investor, you as a planning client, you as whoever you are out there. And I want to be very cautious. This is not considered to be personal, individual advice for your finances, but you need to understand what your risk tolerance is, what your risk appetite is, and what your risk need is. Are you needing to take additional risk? Because if you're not, just because you can doesn't mean you should. Vice versa, in order to achieve the objectives that you have based on your risk appetite and how comfortable you are, where your confidence is with risk, you get to these points, okay, maybe you do want to feather in some of those more aggressive positions if you have those kind of sitting on the sideline, whatever it might be. But the real takeaway here is we're not in green light territory on our broadest view of the domestic equity marketplace. One other just quick note that I'll point out is notice back here at the COVID sell-off. These two marks are going to indicate where this particular indicator, this kind of macro picture indicator, triggered a sell signal and then a buy signal. And we got the sell signal there in late March of 2020, and then we ended up getting the buy signal in late April. So we can see just how fast this kind of signal can move. But it's going to take a very unique situation, like we saw there in the shortest recession in history. There's a lot of other weird attributes to that particular event in time. Mainly, it was artificial in the grandest sense of the term. That we had a government-imposed shutdown, and then we had a just unbelievable stimuli, big air quotes on that, pump into the marketplace. So I bring that to mind because it's not necessarily always going to be the case that we have these prolonged periods of at this point already a year of being in red light territory. It can trigger on and off fairly quickly. So let's move on from there. I'm going to bring up something that I think more people should be aware of. I think that this is being left out of conversation as far as kind of mainstream financial news media coverage. There's been a lot of reinvigorated interest on NVIDIA earnings and Apple hitting close to, if not around, its all-time highs with their launch of their virtual reality headset, and we've got Google doing fairly well, Microsoft kind of teetering out, peaking somewhere near its all-time highs. These are massive companies, right? These are companies that take a much larger percentage share of their major headline indices. The S&P 500 being a cap-weighted index, the largest companies have a larger percentage representation of the performance of that index. So if the biggest companies are the ones doing well, the index is doing well, but that's not necessarily indicative of a strong, healthy investment marketplace. Here what I have in front of you are four major headline indices. We have the S&P 500, we have the NASDAQ 100, which this is an important one to note because there is something critical left out of the NASDAQ 100 by design of that particular index, and that is financials. The NASDAQ 100 is the largest 100 stocks on the NASDAQ index, except for financials. Those are intentionally removed. So not only does that mean you're going to have more representation in terms of other sectors because financial isn't there to appropriately dilute, but because of the size and the types of stocks, that's why the NASDAQ 100 typically is crowned as the tech king. It's going to be heavy in tech, it's going to be heavy in biotech, it's going to be heavy in a lot of the industries that are not necessarily deemed safe investments, let's say. Down here we have the Dow Jones Industrial Index. This is kind of the grandfather index of them all. It's been around a very long time. It once upon a time was the lead index, but because of the expansion of our marketplace in terms of participation and in terms of our economy evolving, we tend to rely more on the S&P 500 as a representative of how our markets are. But down here on the right, what I really want to draw your attention to is the Russell 2000. If you're not familiar, that is a small cap index. That gives us a good indication of those smaller companies. Now, small is a relative term. Be careful when I say small. We're not talking about mom and pops. We're talking publicly traded companies. We are talking very large employers. These are not tiny, tiny companies. However, respective to their, big brothers and sisters out there, they're small. And that's just kind of the way we look at it. But what I want to draw your attention to with regards to these four is notice the divergence in behavior. Now, you might say, well, how can I draw a divergence? I just see different behavior. I see similar behavior across these two. I see kind of something unique happening here with Dow Jones Industrial, and then the Russell 2000 has its own kind of story being told. Yes, that's absolutely true. If we zoom out, though, we get a very different picture. We can recognize that coming out of, again, those COVID bottoms, if we look at that as kind of a starting point for this market event cycle, whatever it might be that we want to look at, we can see that they all behave fairly similarly, with the exception to some degree of the Russell 2000, which had a very aggressive run up there at the end of 2020. Now, it shouldn't be a surprise. At the end of 2020, remember what occurred. We had the announcement that there was a COVID vaccine. There was also an election. So those small companies tend to be more in tune with and more reflective of the, not to say day-to-day affairs of the country, but they're going to be much more sensitive to events that occur versus those larger companies where, changes in terms of, whether you can go to work, whether you're allowed to go to work or not, those are going to affect the smaller companies much more than they're going to affect the bigger companies, or at least that effect will materialize and show itself sooner. There's a nimble nature to smaller companies. There's the net effect of policy is going to affect them more. And in some cases, depending on how you look at DC, their hand in the pot is going to be much less powerful than their large brethren. So keeping that in mind and recognizing we had a lot of the same behaviors all the way up from the bottom of 2020 all the way through the peak in early 2022 or late 2021. And then we end up seeing that kind of shared event of the selling through 2022 across all the indices. But once we had that kind of turnaround point sometime between September, October, November of 22, we get a very different story being told. The Russell 2000, for example, remains very, very in a very similar position to where it was at those ultimate lows that we achieved. The NASDAQ 100 ended up bottoming a bit later than the rest. In other words, it was still going down when, for example, the Dow Jones Industrial had already begun turning itself up. But here we are now where the NASDAQ 100 has really raced up, yet we see the Dow Jones kind of turning over. Some might suggest that major headline indices need to be looked at as though they are roller coaster cars. And if you think about a roller coaster as it's going up a hill, to really get its momentum, we know when you first get on that roller coaster, you get to that point where it's about to go up the first ascent, and it locks into that clink, clink, clink part of the ride. Well, that first car's locked in, and it's relying on the flatness of the track to give it enough to pull up. But as each car comes in, they each lock in, and then they become, dependent on the mechanism to lift them. Once they're to the top, though, that first car launches, but then you sort of find yourself feeling kind of weightless for a moment because you're coming over, but the tail is still holding you back. It's not until that machine pushes that tail up and over that you get that velocity event where the speed really picks up and the car kind of comes down. If you think of your major indices or your major sectors of the market or your major whatever you're looking at, a lot of times they act that way, where you don't necessarily get that broad selling until that last car kind of comes up and over the top and down. You might look at this and say, perhaps these Dow Jones Industrials, this particular index is maybe in the front. Maybe it's the lead car, right? We know that it bottomed first. It had come up, but it seems to have peaked, and maybe it's now going over. However, here we are on the NASDAQ 100, and we have bottomed later, right? Just like that roller coaster. But then, are we reaching that top where we might turn back over? That is a question that we need to consider, and it's something we need to be mindful of. So, if that is the case, if we want to be mindful of that type of possibility out there, maybe let's take it a step further. When we talk about this idea of divergences, okay, we're seeing divergences across these major headline indices. Of course, the small caps aren't really pulling their weight per se. Maybe if you use that rail or if you use that roller coaster car analogy, they did peak and they launched up, but they turned back down and then they tried again and they tried again. Maybe they're not even on the roller coaster. Maybe they're riding a separate ride. Maybe they're not tall enough to, they're not the big ones, right? So they can't be on the roller coaster. But the fact that they do have such a unique behavior as compared to these other indices, I think that is something that you just simply want to acknowledge. You want to recognize that. So if we were to, kind of dive in, let's leave the Russell 2000 for a minute, and let's just dive in, instead of to these major headline indices, let's look closely at the S&P 500 and let's take it a step further there. So On this particular chart, what I have, this is a weekly chart, okay? And it's a weekly chart of the equal weight S&P 500 by way of an ETF. So this is a traded security that I'm showcasing here. But it is taking the S&P 500, and instead of giving it a weight to the largest companies, right? We are equal weighting all 500 plus or minus a few constituents of that index. And then here's the S&P 500. So we know kind of there was a divergence in performance, a divergence in kind of habits or the characteristics of the major indices, the NASDAQ, the Dow Jones, the S&P. But even within the S&P, we're seeing a divergence. So in this case, we have the cap weighted index, where around March, after we saw that selling that was prompted by the Silicon Valley Bank, First Republic, the bank crisis, we now see that the equal weights, they're not doing so well. They're pretty much flat, whereas the S&P 500 cap weighted index continues its ascent upwards. That's, again, not a great sign. We don't want to see that type of behavior. We want to see that there's a lot of strength across the various marketplaces. We don't want to necessarily see a concentration in strength. Where is that strength specifically concentrated? I bet you can guess, but we'll nail into that a little bit further here in just a second. But being that we have this performance kind of disparity between these two, have we had this occur in the past? Have there been situations in the past where the S&P 500 cap weighted index is not performing in line with the equal weighted index or vice versa? And yes, we do have occurrences of this. In fact, if we were to look at these two positions, so SPY is a tradable security that's representing the S&P 500 cap weighted index, and then RSP, which is what we just had a chart of, that's the equal weight. This is taking 90-day, 3-month performance between the two and mapping out the spread of the performance. So as this chart here being the 0 line right along the middle here, as this is in the positive number territory all the way up to +1, that's saying that performance is in favor of the cap weighted index. When it's below, that's performance being in favor of the equal weighted index. But notice, there aren't so many cases, really, where you get above that 0.05 or that kind of 50% above 0 line here. You do have a few occasions there in 98 all the way through 2000, right? That was the dot-com bubble. So those companies that, bizarrely enough at the time, these, all these tech startup companies, a lot of them were getting valuations that were extraordinarily high. They really weren't even real companies in some cases. But we saw that cap weighting, yes, significantly outperformed the equal weight. The rest of the marketplace really wasn't of interest to anybody, oddly enough. Everyone was just a frenzy around this internet thing and anything and everything that had to do with it. But then you kind of move yourself forward, and yes, in 2002 you had a little spike up. 2008 and 9, yep, we did see a big spike there in 2008. And then as we move forward, we see the 2020 event occur. So we say, okay, there's few enough instances where we've been in this kind of rarefied air up here. What does that look like for the markets going forward? Well, here's kind of what it looks like. Now, here are the events in which the 90-day spread was in excess of 6.5. Okay, that's kind of that's the territory that we're in now. So looking at all of these, this is showing the 90-day spread in terms of the percentage spread. And then here's the SPY, so the cap weighted index, and then the RSP, the equal weighted index. Forward returns on a 30, 90, 180, and 1 year basis. So 30, 90, and 180 day, and then 30, 90, 180 day on the equal weight, and then the 1 year later performance. So when we look at this, it actually paints a fairly positive picture. So, so far up until this point, I've kind of been, not to say doom and gloom, but I've been, hey, right now there aren't a lot of really great signs. We don't want to see this divergent performance and everything else. However, you look at this and you say, well, on average, 1 year later, the S&P is up 23% and the equal weight's up 32%, almost 33%. Well, I mean, it almost is self-explanatory, right? You just go equal weight and you call it a day. Not so fast. And here's why I say not so fast. There are occurrences, 1999 being the most standout one, where 1 year later you are down almost 10, 11% on the cap weighted index. However, in that same year, you're up 7%. Talk about another divergence, right? That's a big divergence, which I think does matter because oddly enough, as we're kind of looking at sort of, the nature of today's market, what was going on in 99? And specifically, this occurred 12/24 of 99, and then 1 year later would have put us 12/24 of 2000. We had the Y2K bubble in that event, in that situation there. We had that concern of everything going kaflooey and all those large companies who had kind of an indebtedness to the established system. Potentially they would go under because their systems would fail and everything else. There was a lot of different things in that market that made it unique, just as there are today. But also we can see events like in 2008, where we got that first initial divergence, and 30, 90, and then 30, 90, we still had negative figures coming in 2008. I would say 2008 is probably a little bit more similar to today's situation, although it vastly different in so many respects. So to say that we can rely on these figures and say, yeah, that's what we should shoot for, it's just not out of the realm of possibility. There is some positive indication as we look ahead versus what is otherwise a lot of negative evidence. It's not to say it's 100% negative. So we don't necessarily want to just be running for the hills right now. This is positive news. This is a good thing. All right, moving ahead on that idea, let's look at something that to me, this was just interesting. Okay, we know the NASDAQ 100 was the late car on that roller coaster we talked about. We know that the Russell 2000 small caps are the underperformers right now. But the question becomes, okay, what if I were to price the NASDAQ 100 in terms of the Russell 2000? So what if I took the relative relationship of the NASDAQ 100 price and divide it by the Russell 2000? What can I glean from that? Well, not only can I glean what the tech bubble really looked like in respect to the broader market trend, which I do think is very insightful. Again, everyone's interest was in these tech companies that were going public, that were huge. They weren't interested in banks. They weren't interested in healthcare companies. Nobody cared about anything other than .com. But then as we look here, okay, this band is a standard deviation band, specifically 3 standard deviations off of the average, which is this red dotted line in the middle. So the point by which we achieved in the COVID shutdown world, where small companies weren't allowed to, their employees couldn't come to work. They had to work from home. You could pray and get a government forgivable small business loan. There were some other stimuli out there, but by and large, those smaller companies, we're not talking about Zoom, we're not talking about Apple, we're not talking about Google, we're not talking about Netflix or Disney or any of the other big names out there. We are talking about those smaller companies that are in materials and industrials, and maybe it's a healthcare, or maybe it's a small tech startup, or whatever it is out there. Most of those could not go to work, which is also why we saw this massive elevation in our NASDAQ 100 and our S&P 500. Those huge stocks really carried the market up because everyone was piling their money into those. Some of it was just money that was freshly printed by the Treasury and handed to people in check form, and they were home, bored, didn't know what to do, and they started investing in the stock market because you couldn't lose money at the time, supposedly. I jest. I'm joking. I've got my tongue in cheek a little bit, but recognizing we hit that 3 standard deviation level in terms of that relationship between the small caps and the NASDAQ 100 versus what is the traditional norm. And interestingly enough, we came right back down to the average almost twice. And here we are again back at that 3 standard deviation event. So if we think in statistical terms, 3 standard deviation, that encompasses basically 99% of the likelihood that this would happen. So we are right underneath that. A little peak above that means that we are in 0.01 or 0.1% territory type of thing. And that's not a kind of place where you want to be, but more importantly, it's not a place you tend to hang out. There tends to be a reversion back towards the mean, if not to the mean or below the mean. So this is just an insightful chart to realize just how disproportionately robust the NASDAQ 100 is compared to that small company amalgamation that we call the Russell 2000 that should be doing fairly well respective to the rest of the market if the market is showing real strength and real internal well-being. So let me get my notes back up here and let's keep moving. So taking that into account, let's move ahead and let's keep that Russell 2000 conversation going. But instead of looking at the NASDAQ 100, right, it's 100 stocks, it's got a huge weighting to those big tech giants out there. Okay, let's be a little bit more fair and let's say, how's the Russell 2000 doing as compared to the Russell 3000, which is a much broader index. It is cap weighted. However, instead of just having 100 companies or like the S&P 500 having 500 companies, it has 3,000 companies and then they're cap weighted. So you do get a bit of a dilution of the power and strength of those very few huge companies. When we're looking here, okay, down at the bottom, and unfortunately I should have had this in a whole different color or something to that effect, but this is a correlation coefficient. So how closely these two are behaving to one another on a 21-day rolling average. So about 3-week rolling average. And we can see that by and large, it tends to be somewhere around 1, meaning they behave very similarly to one another most of the time. So then we say, okay, well, what happens if it's not behaving like one another? What tends to be the case? Well, if we end up dropping below a 0.5 correlation on that 21-day rolling, that's what's highlighted here in our red bubbles. I have corresponding arrows above showing what tends to occur in those other indexes, both the small caps and the large cap, which is what the Russell 3000 really represents. 3,000 of the largest companies, cap weighted again. We can see going all the way back to 2002 here, we had a big decorrelation event, and we do have some downward performance following that decorrelation event. Here we are in 2008 and 9. We know what happened there, okay? Of course, the small caps being more sensitive reacted even worse than the large cap index, but nonetheless, they were both down. Here we are in the 2014, going into 2015, we had a decorrelation, and then again in late 15, and I'll explain that one in just a minute. But if we looked at those as kind of collective signals, noting where the market, we ended up getting a big nasty sell-off there in late 2015 and into early the first 3 months of 2016. Remember when we started talking about market seasonality, right? There was a situation in 2016 where January, February, March were really bad. Now, I've said I was going to highlight what went on there. This is when we ended up having a combination of events, but it's more often than not pointed to a Chinese yuan devaluation that they did basically overnight that just shocked the system, the global system. You ended up having circuit breakers triggering on Chinese stock markets basically almost daily. There was a liquidity run on their financial institutions that translated into the world. There was a lot of kind of bickering back and forth between China and America that they were, manipulating their currency, and that effectively, remember the years that we're talking about here, that set the stage for Donald Trump to take his stance against China and their trade manipulation and basically putting the tariffs into place and everything that kind of has carried forward up until today. So these two events are significant, but more importantly, I think the real takeaway here is when these things decorrelate, it's not a pretty picture for some period of time going forward. And then here we are again in 2021, going into 2022, we got a big fat decorrelation, and then we know what happened through 2022. Now, let's just assume, again, here we are in 2023, we know that the Russell 2000 has pretty much been flat in its performance. I mentioned that a moment ago. We know that the larger cap companies have kind of turned up, okay? But this decorrelation event might be a critical signal that we need to pay attention to. That could suggest that sometime over the course of the next few months, we get some aggressive selling. We may not be out of the weeds quite yet. All right. Well, again, what we're trying to do is build the weight of the evidence. We know that there are some positive points out there, but the weight of the evidence right now is not leaning towards a positive outlook. Okay, moving on. When we're looking at the marketplace, we can talk about large companies all day long and small companies, but I think it's also worthwhile to talk about other factors, other considerations around investing. I mentioned at the very start of the talk today that when we're looking at investing and we talk about that, our CHAMP, so CHAMP stands for Carriage House Asset Management Portfolios, right? That is our proprietary name for our managed model portfolios that our clients invest in. But with our CHAMP indicators, right? These are the indicators that we follow that help us design and dictate the decisions made within our portfolios. That red light indicator that we signaled back in June of 2022, we're still technically in red light territory, meaning we want to be out of the riskier marketplace of investments, and we want to be in safer investments, or we want to be in cash, or we want to be in commodities, or we want to be in really a variety of things. Other than those, high growth type of investments that do tend to exhibit higher risk. Now, risk is not always bad, right? Risk can mean return. Risk can mean a loss of assets. Risk just simply means an elevated range of outcomes rather than lower risk, meaning we tighten up the bands and we give up upside potential, but we also limit our downside potential. With that, let's look at the growth to value conversation. I think this is one, to me, has been one of my favorite themes to talk with clients about and to watch, because I think that the market is, with all of its participants, thousands, millions, billions, I don't know, be it institutions or individuals, there are so many hands in this collective pot that we call our capital markets or our investment marketplace. And while each and every one of those people have a whole different belief system and idea and thought, there's something, almost just, there's like a poetic beauty in how that collective organism that we call our investment marketplace really can behave in very organic ways. Not to say that it's predictable. It certainly is not. However, if we're willing to observe it, we can learn things about the behaviors of the market. We can identify where the market, buyers are stronger than sellers. We can identify where sellers are stronger than buyers. We can identify sentiment towards various disciplines or different themes or factors. I mean, there's a lot that can be determined if we're willing to observe. Let's observe the growth versus value conversation. And what I have here is a proprietary indicator that we use, which is using a large cap growth index based on an S&P 500 pure growth index, plus a small cap growth component. And then we're dividing that by a large cap value, again, S&P 500 value, by the small cap value. Plus the small cap value. So what we're doing here is we're getting a reflective representation not only of large value and large value and large growth, but we're getting the large and small company growth constituency plus the large and small value constituency. And with that, we can see some really cool behaviors exhibited by the markets. Going all the way back to 2017, we saw a low here in 2017, just before we saw an ascent up in growth. Okay, so a move from bottom left to top right means growth is growing in favor or is in favor. And then a move from top left down to bottom right means value is gaining favor or value is in favor. So we saw this low here in 2017, and that was a low based on so many of the fears around Brexit in 2016, the Chinese yuan devaluation. There was a lot of risk-off behavior in the markets, and they were flooding into value-oriented types of investments. As we turned the corner going into 2018, it should be noted that 2017, historically speaking, was one of the lowest volatility years in history. That ended up kind of setting the stage for investors' behavior in 2018 because they said, look, this historically low volatility, I want to take more risk now. And then, of course, you end up seeing just that behavior. So again, if we're willing to observe, looking back, again, hindsight is 2020, but we now know the story and we understand what we're looking at when we look at it. Here we are reaching late 2018, and we end up getting that Christmas crash that basically took us down, and we ended up having a full correction, a 10% plus decline in the markets there between December. I mean, it started in somewhere around September, but we saw the real crash in the market come in right there before Christmas on Christmas Eve, and then it wasn't but 3 weeks later that the markets rebounded pretty handsomely. But that's what you're seeing, this dip right here. And then we saw this last move up until late 2019, before we saw one final selling in late 2019. Now, what would have caused that? Well, it could be a number of things. More often than not, though, there could have been a flood to value, a flood to safety, a flood out of risk and into lower risk because there was an election on the horizon, and it was one that was highly contested, tough, ugly, bitter. This is 1,000,001 other words that we can say, but that very well could have catalyzed that. But then as we approach 2020, where I really want to draw your attention is 2020 is really where we saw this big ramp up in growth. And then, of course, we know what happened in early 2020. We saw the COVID event occur, which is where we have this one final red bar. And that red bar becomes significant because it helps us define kind of a critical level that the market basically conveyed to us. We're running up in growth. Growth is strong. And then, whoa, wait a minute. What's this COVID thing? Hold on. Hold your horses. And then all of a sudden it was, oh, wait, everybody has to stay home and we can basically continue business if we're these growth tech companies, and everybody else has to kind of sit on the sideline? Well, in that case, growth is the winner, right? And we see this just massive escalation in terms of growth being favored over value. We saw this incredible escalation in risk appetite for the markets. But that did have an end, right? We know that kind of peaked out in late 2020 and early 2021. And we ended up seeing some selling down primarily in early 2021 because of a really ugly treasury offering from the government. There was this very bizarre behavior in terms of the appetite for the treasury bonds and treasury bills that were being issued. And because of that, there was a big spook fear of, wait a minute, maybe this is too good to be true. And we came to find out, yeah, no, it actually is too good to be true. You can't just print money and not ever have a consequence for such. But I digress. I don't want to get into that, bag of badgers. But because of that, we saw this kind of last move in growth, right? It was, all right, it was just a treasury offering. No big deal. Let's resume business as is. So we see that move back in growth, but then the real hammer kind of came down, and you'll see this week here was at the very start of 2022, and then that selling continued and took us all the way back down into this territory down here, which, mind you, remember when I mentioned we have 2017, right? And we see the 2018 with that flash crash. Well, just before that flash crash, that particular mark seems to be fairly relevant. It was held here, but it didn't necessarily hold after that final wave of selling in 2022. All right, that signaled, okay, value is back in control. Value has won the tug of war for now. But it didn't last forever. And then, of course, as we approached the summer months, we saw value, which at the time was heavily reflected by a lot of energy stocks. Energy ended up, there was the SPR, the Strategic Petroleum Reserve releases by the Biden administration. There were a couple of other factors. There were some increased production on the part of OPEC. And a lot of companies also that had been typically deemed value companies because of their insane revenue growth and their profitability, they actually stopped being value companies and they started being growth companies. So we saw this kind of shakeup occur, and you'll see this yellow territory, we call it the battleground territory. And that's a battleground not just because growth and value are fighting, but because in this case, we had underlying constituents of what is a growth and value company. They may have been changing hands. There's a lot of detail that has yet to be uncovered about that. But it's relevant nonetheless because it helped us also define this other critical line of about 1.8. Now, we see this battleground occur, but look at 2023. 2023 happens, and then boom, growth shoots us right up and out. And here we are, except no, we're not. We came right up to what we deem to be the critical threshold for growth to take leadership over value. But it came up to it, bonked its head, and said, nope, we just don't have enough strength, right? It's that tug of war where the flag is right there. It's about to cross the line. that team's about to win, and then for whatever reason they slip and fall, or they, their hands lose grip or whatever, and then next thing you know, the other team just yanks the cord and it just goes right back. Now, had they yanked the cord? Not necessarily, but it definitely yanked hard enough to say, nope, this growth wave, the NASDAQ 100's big move, right? All these other factors that we've been talking about already, is it really there? Is that strength really there? Not necessarily. And this is one of our greater indicators to suggest that it's not necessarily going to be something that is going to be sustained going forward. The other, piece of the puzzle that we want to look at is we've got large and small, but let's look at large compared to large, small compared to small, mid-cap compared to mid-cap, and let's see what we have. This top band of performance, right, of this chart, these are large cap, these are mid-cap, and these are small cap indices representing core, growth, and value. Value is the teal line, core is the blue line, and orange is the growth line. Now, if I go all the way back to the COVID bottoms, or roughly the COVID bottom, this is April of 2020, we can see clearly across the board, at least in the small and mid-cap area, the value is where you have wanted to be up until this point. Up here, though, it's a little bit of a different story, okay? The core has actually been where you want to be, and a lot of that might have to do, because you'd say, well, shouldn't growth be ahead? A lot of that might have to do with, again, the way that the companies are changing in terms of their revenues and in terms of their business model and how they're going about doing business. What may have once been a value company became a growth company, and then it may have sold off, right? So we have to be a little cautious as to how much we look into this, but let's take it a step further and say, okay, let's go back into the highs of 2021, or the peak before the selling of 2022. Now we get a very different picture in the large caps, right? Look at this wider spread. Growth is down 13.7%. The core down 7.72% still. And then the value is only down 2.43 since those highs. So if you look at this, you say, yeah, I know that this core line has really aggressively moved, but truth be told, even though there was some ugly selling in value in the large space, value's where you've wanted to be. It may not feel like it, but it is where you've wanted to be. But now all of a sudden we have a very different story being told in our mid cap, much tighter spread in performance, and pretty much the same can be said here in the small cap. Although if we look at both of these over this time frame, they've all behaved pretty similarly. Okay, let's go one step further, and let's look at just year to date. Okay, look at just how different these stories are year to date. So I have been building this case up until now, which is we don't really have that broad market strength that we want. Okay, we have concentrated strength in a very specific part of the market. We're not concentrated just in growth companies. We're not concentrated just in large cap companies. We're concentrated in large cap growth companies. But beyond that, this year has not been a stellar year across the board. And that is reflected by small cap value down for the year, barely even on its core, and barely up in its growth. Now, mid cap does give us a slightly better picture, right? 8% up on the growth, 7.4 on the core, and 6.2% on the value. And then up here, though, in the large cap space, plus 17.5%, 11.5 on core, and then 6.3% on value. Now that's year to date. But we know, going back to that previous slide, okay, go back a little further and weather the storm of 2022, you've wanted to be in value. Take that back 2 more steps and say, which is in favor, growth or value? Growth made one heck of a hard push, but for whatever reason, as of right now, it bonked its head and it really could not muster the strength to get up and over that critical line. Doesn't exactly tell the story that we're wanting to tell right now in terms of a positive outlook. All right, last thing domestically that I want to hit on. You've heard about the yield curve enough. My goodness, the Federal Reserve has gotten so much attention. I'm nauseous just even thinking about it. That being said, though, I do think it's worth hitting on this particular chart. This is the 10-year yield on the U.S. 10-year minus the 3-month yield on the U.S. 3-month Treasury, okay? The blue shaded areas are recessions, okay? The recession talk is not going to go away. It is not going to go away because this, among many other indicators, you're going to hear about inverted yield curve. Anytime a yield curve inverts, you're going to get a recession, or it's the top indicator. There's a plenty of, and then people will say, you know, there's plenty of arguments for why that is the case, and it should be the case. But then lately, I've seen a lot of arguments of, oh, that indicator doesn't work anymore. And okay, maybe not. But what I will say, and what I do want my clients and you as well to take away from this, is it's not like it's always an immediate reaction, okay? We have 98 days going back in 2000 to 2001. There was a 98-day period from when this particular 10-year yield minus the 3-month yield went below zero or went negative. We had 98 days before the recession started. Depending on which point you want to measure off of in 2006, 7, and 8, you had either 497 days, 364 days, or 56 days. In other words, this thing signaled and it didn't immediately. We didn't immediately go into a recession. We know what happened. This was actually in 2006 that it first signaled. But we know what happened in 2007 and early 2008. Early 2008 maybe not so great, but 2007 wasn't terrible. But there was also other places to be invested, and you could do so quite successfully at that time. And then again, even going into COVID nobody should have known about COVID. And that's why I've often encouraged people to realize that the effects in the market weren't solely based on COVID. There was some other things going on, specifically having to do with the reverse repo lending window at the Fed. Again, don't want to get into that. But there was a lot of other things going on in terms of our liquidity markets and in terms of our financial health of our marketplace that suggested maybe things weren't all that great. But we ended up getting this thing triggered down. And then either 210 days or 154 days later, we got that shortest recession in history. Take it for what you will. But what you can simply not ignore is that, yes, over all of these other events, you were going from very high interest rates that were a result of Paul Volcker's decision in the early 80s to raise interest rates up to about 22% at the overnight window at the Fed. And we've had consistently declining over the long term interest rates all the way up until 2008, where they went zero, and they stayed zero all the way until 2018. So to say these are the same as this, not necessarily, right? We're in a rising interest rate environment here. These were in an overall declining interest rate environment. However, when this thing inverts, when it goes negative, when it goes below zero, you get a recession sometime between 550 days later. We can't rule it out yet. We're not to that point. If we had everything else was peachy positive and just joyful, okay, maybe we can say we are in a different regime and things are different and we need to be able to look. But be careful saying this time it's different. We have yet to have enough evidence to suggest so. So the next question becomes, okay, you mentioned, hey, in 2007, you mentioned there were some great opportunities to invest. Like where? Not in the U.S. We have had a very long time, right? From 2009 forward. The iShares MSCI EFA Index ETF, so the tradable index, is only up 107% compared to our S&P 500, which is up 462%, 461.69%. If you were to say, which should I have invested in from the bottom of the great financial crisis / global financial crisis, which one should I have invested in? I don't think you have a very difficult discussion to have here. Okay? We have gotten very used to international investing being second class to domestic investing. We have, by and large, most clients out there, and this is a bit of a planning decision or planning discussion, we have a bad habit of over-concentrating to the US. Now, if you are a sophisticated investor who is looking to be very vigilant and work with your portfolio on a regular basis, and you have a number of disciplines and indicators and signals and whatever it is that's driving your decision other than emotion, well, then maybe you can concentrate. And in many cases, that's where you can make a lot of money. Sure, I get that. But if you're also one who's a long-term investor who's looking for stable, steady, risk-diversified growth over time, you can't say that international should be left out of the conversation. Not only did it still end up positive over that time, but the risk metrics of the international market are very different than that of the US. And where things get to be a bit more interesting is when we start to zoom in, okay? This is that same comparison, S&P 500 to the EFA or the iShares MSCI EFA index from the COVID bottom, all right? Notice, they both behaved fairly similarly. However, something occurred around about March, April, May of 2021. Remember when I mentioned earlier the whole treasury bond offering that was just some very unusual behavior? And we ended up seeing some selling down primarily in early 2021 because of a really ugly treasury offering from the government. There was this very bizarre behavior in terms of the appetite for the treasury bonds and treasury bills that were being issued. And because of that, there was a big spook fear of, wait a minute, maybe this is too good to be true. And that kind of spooked the markets. Well, it shouldn't be a big surprise that the US domestic marketplace is a growth-centric market. Our economy is dependent on ideas and generally services. Now, we're also dependent on consumption, of course. We know that. We are a consumption-driven economy. But if you think about the US as a representative of either growth or value, we represent growth. The rest of the world, by and large, is much more in favor of representing value. They tend to be more value-centric. Financial institutions globally represent a larger percentage and a more significant role in their GDPs. Materials, basic materials. I mean, the list goes on, but those things that are considered like consumer durable type of industries versus the consumer cyclical and the tech and the things, biotech, right? Those are US, whereas the consumer durables and the, staples and commodities, those tend to be more internationally centric. So as we look here and we saw that shaky treasury and people were flooding quickly to the value marketplace, but then they turned around and you got that last burst up out of growth. Okay, here it is. The US burst up, but we got a turn down here in the international. But now let's consider what's happened since this pinnacle bottom in September, October, November. How's that relationship look? Well, now we know we're cherry picking here, right? We're not picking the Russell 2000. We're not picking the Dow Jones. We're picking one of the two indexes that is best performed in terms of the headline indexes in the US, the cap-weighted US index, okay? The S&P 500. We know it's doing gangbusters, and this chart particularly was printed on June 2nd, so performance is slightly different as of recording this video on the 5th. But look at where the MSCI EFA index is from that bottom, 29 to 19. Okay, that's not only a very good thing in terms of if you were positioned here, you're taking advantage of that, but that is a very clear sign of strength. Now, it should not also be ignored the fact that the behavior of these two has been fairly similar, right? This particular selling here that came at the end of 2022, we saw the boost up. We saw the financial concerns because don't forget Credit Suisse was wrapped up in the banking calamity. But here we are moving again in kind of in sync. But then you see this burst up in the S&P 500 and you see this corrective measure taken here in the EFA. Well, this doesn't feel good when you're going, what about all that? All right, what about all those tech companies, NVIDIA and everything else? But again, think of that train car or that railroad, the roller coaster cars. This has been the leader, right? This has been the leading index. European or at least developed international exposure has been much stronger than our domestic markets. It very well could be that they're cooling off, just like the Dow Jones is cooling off. And it could be that the S&P is very much due for some cooling off, if not some selling. We have yet to be determined on that. We don't necessarily know, but I do think it's worth being very vigilant as we enter these summer months where we have that compressed performance range on average, where we have growth that tried to make a big rally but just simply couldn't mount that critical level, where we have small caps to the NASDAQ 100 relationship significantly out of what should be a normal range, right? That third standard deviation event has occurred again. There's a million and one, of course, the 10-year versus the 3-month. There is a significant amount of evidence suggesting that we are going to see some additional selling before we find ourselves out of the weeds, in the clear, in a position where we want to bring in additional risk into the portfolios for the sake of growth. Now, risk can be brought in, but it may benefit you to consider alternative markets to bring it in, not just the domestic US stock market. Fixed income, very different world we're living in, as I mentioned earlier, right? Rising rate environment versus declining rate environment. We might find ourselves in a declining rate environment again. The Fed has a really bad habit of pivoting on policy either too soon, too late, or too fast. And it is likely, they've already gone too late, and then when they did take a decision, they went too fast. So I'd be willing to bet the next thing they're going to do is do it too soon, which means let their foot off of the gas in terms of raising rates too soon with respect to what their ambitions are. They very well may cut rates by the end of the year. I don't think they will. I think they'll probably keep them where they are. But that will also allow some catch-up events to occur in terms of the lending marketplace, in terms of like mortgages, car loans, and that kind of thing. Institutions will be able to, not to say get creative, but they will be able to adjust to the changed environment in a way that benefits their business line, which in turn will probably result in a better borrowing environment if you're a borrower. That's been, one of the kind of hiccups in our economy right now is you want to go out and you want to get a mortgage. You don't want to play that game, right? 7% is pretty ugly, especially if you're in a home right now with a 3 or a 2.5%, mortgage rate. If you're going out and buying a car, most recent data over the weekend, the average car loan rate in the U.S. right now is 8.68%, I believe. Boy, that is a heck of a lot of money to be stroking when the car market still remains, I would say, artificially inflated. You are paying a premium for cars right now. You still are. New or used, doesn't matter. So to pay a premium on the vehicle and then to also, turn around and have, close to 9% on a loan if you're borrowing against that car, not a good place to be in. Credit cards, 23, 24, 25, up to 30% on average credit cards. These are not, payday loan advance type of relationships with lenders. These are your average credit cards out there. If you have credit card debt, I implore you, please seek to eliminate that debt right now. Be fully aware of what you are paying in terms of your APR on your credit card. So many Americans are starting to either charge off or not pay down their debt, their balances. They're paying minimums again. This is not good. If you can avoid that, please do. It will eat you alive. But with that being said, for clients of Carriage House Planning, I'm going to have a companion video that's going to talk a little bit about portfolios. So keep an eye out for that. But for everyone else, if you have any questions about your personal financial planning, if you're concerned, if you want somebody to talk to, or if you just want a second opinion on what you're currently doing, give us a call. You can find us on www.carriagehouseplanning.com. You can schedule an introduction meeting there on the website. It's very convenient and easy. If you just simply want a second opinion on your portfolio and you're saying, hey, I want somebody with some market experience to take a look at this, I'm happy to do so. Give me a shout. I'd love to chat with you. Love to learn a little bit more about you and your long-term goals. And if Carriage House Planning can play a role in helping you achieve those goals, all the better. But until then, I hope you all have a great day. Enjoy the summer months. Be safe. And hopefully I'll talk to you soon. All right.